The S&P 500 just hit the 99th percentile, and the S&P at this level has historically marked a regime inflection. Something is breaking beneath the surface, and the data confirms it. Right now, the S&P 500 is at 7,473.5, the 99th percentile for the past year. Historically, the S&P at this level has historically marked a regime inflection. Gammon says, the Fed is breaking things, and credit spreads will blow out. Snider says, the euro-dollar system is tightening, and nobody sees it. In the next few minutes, I will show you who the data says is right, and what it means for your money this month. The commodity analyst has been right for 156 straight days. Here is the full scoreboard. Score 1 for the commodity analyst. Commodity supercycle. Oil agrees at $96.6. 156-day streak. Snider's dollar liquidity crisis call is paying off. Yield curve at 0.43% and trending their direction. 6 days running, Gammon is right and the data keeps proving it. Yield curve at 0.43%. 4 days running, the volatility expert is right and the data keeps proving it. VIX at 16.8. 4 days running. McElroy might be right, but the data has not confirmed the thesis yet. 155-day streak. Hartman might be right, but the data has not confirmed the thesis yet. 149-day streak. Too early to call the dollar analyst right or wrong. The thesis is building, but not confirmed. 3 days running. Score today, 4 right, 3 early, 0 wrong. A streak this long means the trend has legs, but long streaks end eventually, and when they do, the reversal is sharp. Today's big question, everyone agrees on credit, so who's wrong? Gammon says the Fed is breaking things and credit spreads will blow out. Snider says the euro-dollar system is tightening and nobody sees it. Everyone agrees. In markets, that is usually the setup for a reversal. The crowd is most confident right before the data breaks against them. Here's what the data says. Investment grade spread at 75 basis points. High yield spread at 278 basis points, down 0.7% today. Yield curve at 0.43%, down 12.2% today. Bottom line, everyone agrees. The data hasn't broken yet. History says watch for the reversal. If investment grade spreads crack above 100 basis points, the bearish thesis gets a lot harder to ignore. Right now, they are at 75 basis points. If both investment grade and high yield drop below the 75th percentile, the credit stress call is dead. Investment grade spread at 75 basis points. We'll track it daily on the scoreboard. High yield spread at 278 basis points. We'll track it daily on the scoreboard. Phase 1 is the good times, but good times do not last forever. Here is how close we are to the edge. We are 75 basis points away from Phase 2, the phase where credit breaks and volatility spikes. There is no acceleration in credit stress yet, but we are watching the pace, not just the level. The trigger, investment grade spread crossing 150 basis points. Currently at 75 basis points. Pace is flat or improving. No urgency right now. Phase 1 means risk on is working. Equities, commodities, and real estate all benefit from loose conditions. Enjoy it while it lasts. For context, the last time credit stress built like this, credit spreads blew out and high-yield bonds saw drawdowns of 15%. The credit and rates layer has initial jobless claims, copper-gold ratio flashing red. Snider says the euro-dollar system is tightening and nobody sees it. The data agrees with that assessment. Phase 1 holds with 75 basis points of buffer. Conditions favor risk, but do not get complacent. Wall Street trades the index. We trade the ground. Here is what the ZIP level data is screaming about today. Beaufort County, SC, payment burden is past the breaking point. Sheldon, SC, median home about $2,321,000 on about $117,000 household income. Price-to-income ratio, 19.9. When the math stops working, sellers find out before buyers do. Curry, or payment burden is past the breaking point. Sixes, OR, median home about $415,000 on a about $21,000 household income. Price-to-income ratio, 19.7. When the math stops working, sellers find out before buyers do. Routt County, CO, builders are pouring concrete where nobody can afford to buy. Routt County, CO permitted 597 units this year, up 81% year over year. Affordability scoring 80,000, 428, 1428, 1428, 1420, 100. Supply chasing demand that doesn't exist at these prices. These are not hand-picked metros. They are the loudest signals in the housing data right now, chosen by the numbers, not the narrative. Today's debate asked, everyone agrees on credit, so who's wrong? Let me show you what happened the last time we were here. The S&P 500 at 7,473.5 is in the 99th percentile. That means it is higher than 99 out of 100 days in the past year. In 2022, the S&P dropped 25% as the Fed raised rates at the fastest pace in 40 years. In 2020, markets fell 34% in 23 days, then recovered to new highs within 5 months. In 2018, a 20% correction in Q4 forced the Fed to reverse course on rate hikes. Different environments, different catalysts, but every time, the resolution came fast. The pattern is not the level, it is the speed of the move once it starts. Meanwhile, copper at $6.38 is in the 98th percentile. The last time both the S&P 500 and copper were at these levels simultaneously, the resolution came within weeks. That is why the scoreboard matters. It tells you which speakers saw it coming and which ones missed it. If history rhymes, Gammon should be paying close attention because the clock is ticking on this pattern. Here's what the data says to do right now. Stay alert on VIX. It is dropping 3.9% today. Fast moves demand attention. Avoid Phoenix at 41% payment burden. That is stretched territory. Phase 1 holds. No alarms. But the runway at 75 basis points is shorter than last month. 4 out of 7 speakers are right, the commodity analyst Snider, Gammon, and the volatility expert. When this many align, the trend usually has legs. Every signal is live at analyze.builderslens.com. The podcasters give you the thesis. We give you the scoreboard. Subscribe and I will see you tomorrow morning.